BETR might be the most important Roth conversion idea you hear this year. Here's the basics. A traditional IRA gives you a tax break going in, but taxes every dollar you pull out in retirement, while a Roth works the opposite. You pay tax up front for tax-free withdrawals later. Most people hear one simple rule: convert if your tax rate will be higher in retirement, don't if it will be lower. But Vanguard's new BETR strategy shows this old rule is often too simple, and there are situations where a Roth conversion can still help even if your future tax rate is lower than today. Getting this wrong can mean thousands more to the IRS over your lifetime, so let's walk through BETR, your personal break-even tax rate, together. What BETR really means. Break-even tax rate. Let's simplify BETR. Think of BETR as one special number, the future tax rate where you would be exactly even between never doing a Roth conversion and doing a Roth conversion today. If the future tax rate you expect in retirement is higher than that BETR number, the conversion likely helps you. If the future tax rate is lower than that BETR number, the conversion likely hurts you. So instead of guessing higher or lower than today, you now have a break-even line you can compare against. Stay with this, because this is where Vanguard's work really changes the conversation. A simple kitchen table example, the Jill story. Vanguard shares a case study that many educators online have picked up on. Imagine a retiree named Jill. Jill is in the 35% tax bracket today. She expects to be in the 24% bracket in retirement. She is thinking about converting $100,000 from a traditional IRA to a Roth. The old rule would say, future tax rate, 24%, is lower than today's, 35%, so no conversion. But Jill does something smart. She pays the conversion tax bill using separate taxable money, not from inside the IRA. Vanguard then runs the math over 20 years and finds that in Jill's case, the break-even tax rate is about 23.3%. Her expected future rate is 24%, just a hair above that break-even. So a conversion can actually leave her better off, even though her future rate is lower than today. That's the BETR idea in action. Not higher versus lower than today, but higher versus lower than your personal break-even tax rate. This can feel confusing, and that's okay. The next few pieces will slow down and show the three big levers that move that BETR number around. And that's where you get real control. Lever number 1, where the tax money comes from. Vanguard and several of the best explainer videos on this topic all hammer the same idea. How you pay the conversion tax matters far more than most people realize. Think of 4 simple choices. 1. Pay the tax out of the IRA itself. You convert, say, $100,000, but then withhold part of that to pay the tax. Less money ends up in the Roth. In Vanguard's research, when the tax comes out of the IRA, the break-even tax rate basically equals your current tax bracket. 2. Pay the tax from a tax-efficient taxable account, maybe a brokerage account with index funds where most of the return shows up as deferred capital gains. Now, instead of losing IRA dollars, you move more money into the Roth and use less sheltered dollars to pay the tax. Vanguard finds that this can push the BETR down noticeably below the current rate. 3. Pay the tax from a tax-inefficient taxable account. Think of money sitting in bond funds that throw off taxable interest every year, or other investments that create a lot of annual tax drag. Using those dollars to pay the conversion tax often lowers the BETR even more, because you are moving money out of a high tax drag pocket into a tax-free Roth pocket. All of that math is in the research paper, but the plain English point is simple. The more tax-inefficient or low return the dollars you use to pay the tax, the more a Roth conversion tends to tilt in your favor over time. This is where many retirees get stuck. They only look at the tax rate and forget to ask, which pocket is the tax bill coming from? Uncle John really doesn't want that detail to sneak past you. Lever number 2, your basis.
money you've already paid tax on. The second big lever is something called basis. Basis is the slice of your traditional IRA that came from after-tax contributions. Money you already paid income tax on when it went in. Only the growth on that slice is taxable later. Some folks end up with basis because their income was too high to deduct IRA contributions in some years. They intentionally made non-deductible IRA contributions. Here's why this matters for BETR. When you convert a traditional IRA that has basis, the pre-tax part of the account is taxed in the conversion year. The basis part converts tax-free. Vanguard's research shows that the higher the share of basis in your IRA, the lower your BETR drops. In other words, conversions get more attractive because more of what you are moving is already pre-taxed money. One of the YouTube presenters walks through how, with a 50% basis, the break-even rates in Vanguard's charts drop dramatically compared with a 0% basis account. So if there's any chance a traditional IRA includes after-tax money, this is not something to guess at. Form 8606 on past tax returns can help a tax professional track that basis. Stay with this just a bit longer. This next part, the backdoor Roth, is where the BETR strategy becomes a real long-term planning tool, not just a one-time decision.
Lever number 3. Unlocking future backdoor Roth contributions. High-income retirees and pre-retirees often hear this: you make too much to contribute directly to a Roth IRA. But there is a legal workaround called a backdoor Roth. Here's the heart of it. Make a non-deductible traditional IRA contribution, then convert that new contribution to a Roth soon after. If the account hasn't had time to grow, almost the entire conversion can be tax-free. The catch is the pro rata rule. If there are old pre-tax IRAs hanging around, the IRS makes you blend them together when figuring how much of the conversion is taxable. Vanguard's BETR paper shows if a person clears out those legacy pre-tax IRAs by converting, or in some cases rolling them into a 401k, then starts doing annual backdoor Roth contributions, the long-term break-even tax rate for that first conversion can get very low. In some of their scenarios, only a few percentage points. Once the deck is cleared and future contributions all go into the Roth through the back door, the BETR can drop to a level where even fairly low future tax rates still make the initial conversion mathematically wise. In plainer words, paying some tax now can open the door to years of tax-free growth in the Roth. When you add those future years into the picture, the original conversion often looks better than it did at first glance. Hidden benefits, RMDs, Social Security, and Medicare. The Vanguard team also points to something retirees feel very directly: required minimum distributions, and how they can snowball into other problems. Traditional IRAs and most 401ks force RMDs starting in your early 70s. As you age, the required percentage goes up. Large RMDs can push taxable income higher in your 70s, 80s, and 90s, trigger more of your Social Security benefits being taxed, push you into higher Medicare IRM-AAA brackets, which means higher Medicare premiums. Roth IRAs, under today's rules, have no lifetime RMDs for the original owner. So part of the value of converting is not just my tax rate today versus later, but do these conversions lower my lifetime tax burden and future surcharges? That's hard to see when only looking at this year's tax bill. But Vanguard and several careful educators online keep reminding viewers retirement tax planning is a multi-decade problem, not a one-year problem. If it feels comfortable to share, has anyone in your family ever been surprised by how much taxes or Medicare premiums ate into their retirement income?
Stories like that are exactly why these BETR tools were created.
Now, how does an ordinary 55 to 75-year-old actually use this? Here is a calm, practical way to think about it. 1. Get a rough picture of your future tax rate. Not perfect, just a reasonable estimate based on your income sources, filing status, and today's brackets. 2. Use a better style calculator or work with a pro. Vanguard has a Roth conversion calculator for advisors that applies this framework. Many planners are beginning to use these tools with clients. 3. Check where your expected future rate sits. Is it above or below the better the analysis gives you? 4. Look at the three levers together. Are taxes able to be paid from a taxable or cash account instead of an IRA? Do your IRAs have any after-tax basis? Would a conversion clean things up enough to make backdoor Roths possible for a few more years? 5. Consider partial, gradual conversions. Vanguard reminds readers that conversions do not have to be all or nothing. Doing a series of partial conversions in lower income years can spread the tax hit and give more flexibility. 6. Always check the impact on Medicare and Social Security taxation. Those are tied to income. A big conversion in 1 year might push income temporarily too high. A thoughtful multi-year plan may work better. None of this replaces a good CPA or a fee-only fiduciary advisor. In fact, several of the YouTube educators walk through exactly how to present this research to your advisor so that the conversation is grounded in real data, not just rules of thumb.
Let's bring this in for a calm landing. The BETR Roth conversion strategy from Vanguard is not a trick, not a loophole, not a get-rich scheme. It simply says, stop looking only at today's tax rate versus tomorrow's. Instead, find your personal break-even tax rate. Remember that only paying the conversion tax from the right account can tilt the math. Any after-tax basis in your IRA makes conversions more attractive, and opening up future backdoor Roth contributions can turn a maybe conversion into a clear long-term win. And always keep in mind, Roth accounts can help reduce future RMDs, which can lower future taxable income, which in turn can ease the tax hit on Social Security and help avoid higher Medicare premiums down the road. Decisions made just before and just after retirement often feel like one-way doors. Taking the time to understand them, slowly, clearly, without pressure, is a real form of self-care.